Hello, guys. I'm going to wait for a few people to jump on in. Welcome. I'm going to stop sharing screens so that we can hop on in. I do have a screen to share, right? So I'm thinking the YouTube channel, we may need to eventually share that in the Facebook group um, because I do want to share a calculator that I use to do underwriting. So just a heads up there, and I am waiting for the thumbs up. Okay, I've got the right mic, all the things, and I need to figure out how to switch to the right screen eventually, but we will get there momentarily. So all is good. Welcome everyone. Again, we're waiting for a few folks to dive on in. Today is part 3 of our training session. We have been going really hard on market analysis and then property comparisons. And finally, last but not least, today we're talking all things underwriting. So I would love it if you guys let me know that you're here, that you can see me, that you can hear me. That way, I know that we can go ahead and get started. Okay, so I'm getting the thumbs up, guys. I'm getting the thumbs up. It is all good. Um, oh my goodness, guys. Oh my goodness. Well, not to be a certain kind of way, but nevertheless, I will share with you a quote that I saw today that resonated with me so much that I thought, you know what, I'm going to get on here. We're going to have a powerful live today because I think that's where we draw our power from, our ability to make decisions. Our ability to make decisions is what allows us to create a movement. And so with that being said, Martin Luther King once said, only when it is dark enough you can see the stars. Only when it is dark enough you can see the stars. All right, so I'll let that breathe for a second. With that being said, hello, everyone. Welcome back to another Luxury Rental Doctor podcast. I'm Dr. Rachel Gainsborough, your go-to healthcare professional turned real estate investor. I operate out of Georgia, Florida, Arizona, Texas, Tennessee, and Philadelphia. You might have seen one of our luxury midterm rentals featured on Netflix, or you may have seen me grace the TEDx stage. But what really drives me and what really lights me up is the ability to share with you the invaluable information that we are sharing tonight for our hardworking, busy professionals, women in medicine, just fighting for their lives, juggling all things on these real estate streets. So I know you guys hold multiple roles, and I'm super passionate about how can I make things better for you. And so today we are diving into part 3 of a 3-part series, part 3 of a 3-part series. Yes. So this is the final part, and we're focusing on the all important step of underwriting. Okay. Now, we will be breaking down the underwriting process today because just two well-positioned properties, guys, can make a huge difference in your portfolio and in your life. And so if you have if you've carefully positioned yourself when you're purchasing one investment property, when you're purchasing the second investment property, if you've positioned yourself to maximize returns, this is what we're talking about. And so I'm all about quality over quantity. I'm all about value over volume. And it really blows my mind how these extra special touches can completely decimate your competition. Okay. Not that we're going into, harm anyone. I like to call them colleagues, our competition. However, it really moves the needle without you having to invest in dozens and dozens and dozens of other properties. And so we've talked about so many strategies inside of the community, strategies that leverage taxes, right? It's not all about like, let me take down 10 more properties. tax strategies. This is something that is written in the code that you can take advantage of today. Do not sit on the sidelines waiting for someone to come and rescue you. Help is not on the way, my friend. Help is not on the way. I'm just going to leave it at that, okay? Help is not on the way. You can take advantage today, right now, and stop sitting on the sidelines and start to build those building blocks to make sure that you are setting yourself up for success. You're setting your family up for generational wealth. Okay. So, in part one, we dove deep into market analysis. We focused on identifying the best locations, and I even gave you a feel for the revenue potential of short-term rentals using tools like AirDNA. We went in. Okay. So, this is the foundation. I just got off a podcast episode with a lender, and come to find out, the lenders are using AirDNA as well, which is a data tool. It's a tool that has reviewed and has access to the data, how much rentals have made over the last 6, 7, 8 years. So why reinvent the wheel? Why not go to where the puck is already going, right? So that is the foundation. When I tell you lenders are using that tool, we should be using it too to make sure that we're setting ourselves up for success. Okay. All right. So that is the foundation. It indicates that you're choosing the right market. You're choosing areas that are already profitable, areas that are already in demand. So that was part one. In part two, we covered the PACU methodology, trademarked, right? That's proximity, amenities, comps, or competitive edge, and quality. Okay, so that portion helped you to break down the must have, I would say, metrics or benchmarks for a successful property. Why can one property demand $100,000 in a market and its neighbor can only demand $50,000, right? That's the question you need to ask. And PACU helps you to answer that question and helps you to position yourself to stand out from the crowd and to outperform your colleagues, okay? And I want to add in there as well with PACU, of course, I've got an allergic reaction happening to my face. I want to add in there with PACU, it helps you to identify also, well, what are the key indicators that you're not going to be in what is called the red ocean, fighting for your life like it's a feeding frenzy, right? Amongst this sea of thousands and thousands and thousands of listings. What's going to make you stand out for the crowd so that you're not crying saturation to me? That's what I do not want for you, my friend. I don't want you to come to me crying saturation, saturation, saturation. Okay, my glasses are glaring, and so that's annoying me right now, as is quite a few things. Okay, so I don't want you crying saturation to me. I don't want that, okay? In order to ensure that you're not crying saturation, we need to understand the behavior of the market. We want to understand whether or not the revenue that the market is making as a whole right now, compared to the number of properties that have entered into the short term rental market, are on an upward trajectory. Are they trending together upwards? More properties, more money. However, if there are more properties, right, and then the money is taking the nosedive, right, revenue is decreasing, that tells us, oh, we're not in Kansas anymore. There may be trouble on the horizon, ergo saturation. Okay, so if I see more listings, that might be an indication of demand, as long as the revenue is going upwards as well. Like, what's the direction? As long as the revenue is increasing and the listings are increasing in a similar trajectory, then that tells us, wow, this market is growing. There's demand. Folks are coming to the market. However, again, if the revenue is going downwards, the amount of money that the market as a whole is making is going downwards, and the number of listings are skyrocketing. English is my third language. If it is skyrocketing, this is an indication to us. Guess what? There's trouble on the horizon. Okay. So be mindful of that. Be mindful of that. That is the difference between demand and saturation. It's very scientific, it's an economical term. I want to make sure that you're fully aware. Okay. So for today, my focus and that information, let me rewind a little bit. That information can be found in the data tool that we know, like, and trust. it is AirDNA. We use AirDNA quite a bit. For all of that analysis, they have access to all of that information from years and years and years. Okay. So you get to see the revenue potential, you get to see the number of active listings, and so be very, very mindful of that. Now, for today, I want to talk about part 3. Part 3 is everything underwriting. Everything underwriting. Feel free, my dear friends, to go ahead and start dropping everything in the chat. Everything. Feel free to drop all your questions in the chat as we go along, okay? I'm going to switch to share my screen in a moment, and it's already making me nervous. I'm going to be honest. I'm a little bit nervous because I can't figure out where anything is. But we're all here, right? It's family that's here, right? We're all family here. So hopefully I can figure it out together. Okay, there it is, main camera. Let's see what that looks like. I have no idea if that's the right screen or not, but maybe it is. Maybe it is. Maybe it is. All right. So all is good. So today for part 3, we're taking it all the way to underwriting a deal. Okay. So we want to analyze the deal. I want to show you a little bit about how I evaluate the numbers that my property is projected to make, right? And then I want to calculate the returns because it's a two-part equation, right? Income that's coming in and operating expenses that are going out as well. And so I want to show you how to evaluate these numbers, okay? So if you're ready to take a look at one of the calculators that I like to use, and I want to share this with the community, I need to figure out how to share it with the community. But if you're ready to take a look at one of these calculators that I use, give me a 1 in the chat. Excuse me. And while I'm getting some ones in chat, let me know, right, when I need a couple ones in the chat just to make sure, because I'm having a lot of trust issues right now. And I just kind of feel like maybe, just maybe, I'm not broadcasting out to all the places. I can find my selfie stick, guys. I'm just, listen, on a day like that, I am just so grateful to be here. Give me a 1 in the chat if you, my friend. Awesome. Okay. Awesome. I'm getting some confirmation. So let me see. Oh, look at that. Okay, the right screen. All right. The right screen is being shared. This is exactly what I had hoped for. So, right, let me know that you could see like I'm this little bubble here that is hopping around. I think I'm doing it right. I hope I'm doing it right. Yeah. Okay. Yep. Okay. So I just got the thumbs up. I just got the thumbs up, everyone. Okay. So you can see my screen. All right, dear friends. So here's the deal. We looked at a couple of properties last week and we evaluated them. I want to pull up for you. Let me see what there we go. All right, so here's an example. Boom. Here's an example. So once I have evaluated the properties on AirDNA and I've determined, you know what, these 4 or 5 properties, they make the most sense for the type of property that I'm leveraging, I'm going to go ahead and create like a little a favorited list with all the properties and combine the aggregate metrics. So here's an example of combined aggregate metrics for said properties. Okay, so together these properties are generating $51,314 as an aggregate. The average daily rate is $313 per night. The occupancy rate is 48%. I prefer 50%, but 48% is close enough. The revenue per available room, also known as RevPAR, is $153. Okay, I'm going to pull this out because I want to hide all of my emotional support tabs so you guys don't know how much of a clutter monster I am. when it comes to all of my tabs. Okay. All right. So, yes, I have trust issues and I like all of my tabs all in one place. All right. So, for those of you who are listening online right now, I am sharing my screens. I have two screens up. On the left, I have my cash on cash calculator. This is my short term rental cash on cash calculator. This is one of the calculators that I use to do my underwriting. Right now, actually, we have a developer that built it into our system, so it's much easier to use than just the spreadsheet, but the spreadsheet is fine as well. And on the right hand side, I have my favorited list of properties that are painting a scenario to set of properties in New Orleans. I was evaluating with one of our clients, and it's kind of painting a scenario for us as to how much we believe this property can generate. Okay, so we want to look at two things. We want to look at purchase price and all of the things. So let's give ourselves an example. So a scenario. So this particular property is in New Orleans. I have a property here in Davenport, Florida. I'm just going to leave that there. However, I would update that if I had the address handy with me. From there, I would add the actual listing from Zillow or Redfin or Realtor.com or even Airbnb. And then from there, I would add any ideas in terms of what is the short-term rental regulation environment like in this particular market. And so here it says short-term rentals are allowed, and if there are permitting information, for instance, there might be a license or license fee, I would go ahead and add that in here as well. Okay, and so from here I am adding a few more details about the property. So the unit type, as you can see here, is a single family home, bedroom count, bathroom count, occupancy rate, and so on and so forth. So for this scenario, I actually want to walk you through how I would use my aggregate metrics here to fill this out. So I believe these are, let's see, these are 3-bedroom properties. So let's go with 3 bedrooms, 2 bathrooms, it's 1, and then 48% is the occupancy rate. Average daily rate is $303. So I went ahead and filled this out based off of the information in here. You see, 303 average daily rate, 48% occupancy rate, etc., etc. Purchase price, I believe the purchase price of the property we're looking at was $325. All right, closing cost is about 1.5%. And these are closing costs such as like the title fees, like the non-lender closing costs. So appraisal, title fees, home inspection. So this is just an estimate to give you an idea. Immediate repairs. So for the property that we're looking at, did not need immediate repairs, but we wanted to update the carpet or the flooring. I like hard flooring, to be honest. Furnishing costs. So for our 3 bedrooms, we have a deal with quite a few of the Pottery Barn and West Elm vendors, and so we get wholesale pricing. So for our 3 bedrooms, it's about $12,500. For 4 bedrooms, it's $16,400 or something along those lines. And so there you have it. So this is the initial investment here. And in the financial assumptions, the down payment. So our member is leveraging a 10% down second home loan or investor occupied loan, something along those lines. So they're using a 10% down loan, which is amazing. The loan closing costs, they differ. So as you can see here, I'm going to actually zoom in a little bit so that you can clearly see. I'm hovering to discover. So this is deal specific closing costs. So for the loan, there's loan origination fees. Here we go. There we go. Loan origination fees, mortgage points, underwriting fees. So it's very deal specific. Interest rates. Oh my goodness. So I was just on a call with a few lenders, and turns out that now that the election, I know it was election day yesterday, has come and gone, the markets interest rates are projected to go up. Okay, so with that being said, let's go back up to our 6.5%. The loan type we're doing an AMRT upfront equity that is forced into the property is $81,113. Okay, so these are our financing assumptions, guys. Okay, so all of the additional pieces of information we're going to fill out is towards the right. All right, so towards the right, here are some fillable cells. So if you noticed a little bit earlier, we've been filling out the information that are in the pink cells. We're going to continue on that same vein. Some of this information has already populated. So in pink, we can add any other income we anticipate that we would draw in for the property. For instance, let's say that the property has rental opportunities such as a golf cart rental, and you're projecting what that property can make based on what you have seen in that market. You can add that in there. Channel fees. What channel fees are fees that Airbnb Vrbo would charge for listing your property on their platform. So they do not charge an upfront fee. However, Airbnb and VRBO, they do charge per booking. Okay, so keep that in mind. It's about 3%. Management fee. Hopefully, you're here because you want to self manage and keep a few more of your dollars and take advantage of the tax strategies that are out there. Okay, so management fees, let's just keep it at 0 for now. And any other fees you want to list it in here. Okay. All right. So let's talk about the expenses associated with your property. So, property taxes. Be mindful, guys. Do your due diligence, double, triple check. So, we just put a property under contract in my community. In that particular county, the property taxes are now $20,000. This is in Texas. That's a lot of money. That would be like $1,700 a month extra. Okay, extra. That is a lot of money. So, do your due diligence. Property taxes, I have seen it completely pull the rug under unsuspecting individuals. I don't want that to happen to you, my dear friends, my gems, my amazing gems. So do your due diligence. Make sure you're looking at property taxes. Go ahead and give a few insurance companies a call. Just give them a little bit of a shout out to see, okay, can you give me some quotes on homeowners insurance for this area? Okay, call around for quotes. That's what I have in here in this little hover to discover. And then you want to go ahead and add that in. HOA fees. I don't love HOA fees. I prefer not to, but some of you are in markets you can't avoid it. I have 10% for the utilities, internet slash cable. Most of our properties do not have cable, just internet, Wi-Fi, admin fees, pest control, household supplies, maintenance or capital expenditures. So the newer the home, the less maintenance it should require, right? In the ideal situation. So approximately 1 to 5% is what I would allocate for capital expenditures. So if it's a brand new home, maybe 1%. If it's an old home, 5%. And if it's an older home, but it's newly renovated, I would treat it as though it's a newer home, okay? Allegedly, right? Allegedly, right? In the real world, this is not always to be expected. Okay, so when it comes to the next row down is technology fees. Technology fees are averaging about $50 per property. So let's be mindful of that and any other additional expenses. Okay, so with that being said, here are our numbers and here's our go, no go signs. Okay, so our net operating income, your net operating income essentially is the total amount of money that's coming in minus the operating expenses that are going out. That is your net operating income. So money in minus the money that's going out. The goal is for your net operating income to be as high as possible. I will let you know that as far as net leverage, net cash flow is where I draw the line. And I'll tell you a little bit about that. Okay. So net operating income in this situation is 2908, which is fine. However, with the loan payment of 1867, that's principal and interest. So that's PI It's not TIA with all the expenses, but the leverage net cash flow is your cash flow after the debt. Now, the goal that I have set for you is for you to have a leverage net cash flow of $1,500 or more. And this one is short. It falls short. It does not prevail. The leverage net cash flow is $1,041. So $1,000, $1,041. Okay, so this is a no-go for me. However, let's continue on because I want you to familiarize yourself with the additional return metrics in here, okay? So the gross yield, which is also known as the gross ROI, this is a number that I look at when I'm initially evaluating an investment. It's essentially the purchase price of the property compared to the revenue potential of the property. So that's the gross yield. My goal is for you to be at 15% or more. 20% is ideal, especially if you're using investor funds. However, 10%, if it's a really good deal and I see a path towards me getting my cash flow, I may go in with a 10%, especially if I'm using tax strategy or something like that. So keep that in mind. Cash on cash, again, similar, 15% is the goal. 10% is last resort, 20% is ideal. And what cash on cash indicates to us is, well, you know what? I just invested these funds. How quickly can I get it back? That is cash on cash return. And cap rate, I don't pay attention to this much unless I'm using a bank statement loan that is for banking purposes only. And I have it here just so that you're aware. Okay. All right. So, from an expense ratio perspective, expense ratios are about 40% or higher for newbie investors. We're able to keep ours down to 35% or less. So, if you share with me that your expense ratio is something like 18% or 20%, I call BS because that is not reality. So for me, this is a reality check. If your expense ratio is completely out of whack, it's telling me that you are not being conservative enough. You're aggressively, barreling into the deal. That is not a good deal. When it comes to short-term rental, expenses are high. When it comes to midterm rentals, expenses are low. And what I mean by expenses is the money it takes for you to operate the property, the cleaning team, the turns, the replenishment of the consumables, right? So that's why I love midterm rentals. My expense ratios for midterm rentals are at about 15%, but my expense ratios for short-term rentals are at about 35%. Okay. So I'm not sure if you guys were aware of that, but that is the case with expense ratios. Okay. So DSCR tells us really whether or not the loan that we are leveraging is going to make sense for the cash flow that's coming in. So the DSCR, the goal is, or the debt service coverage ratio goal, we want it to be greater than 1.5%. So essentially, it's telling us that the funds that are coming in will cover the loan by 1x or 1.5x. Dare I say like 3x? I would love a 3x DSCR situation, so for me, that's great. And then lastly, we've got the debt service percentage. So this is kind of the same information, but presented in a percentage format, right? So it's important to look at it from different angles. So I want the income that's coming in to cover my funding, the loan, the mortgage payment month after month. And I want to have greater than 65% of my funds left over after the mortgage is covered. So this debt service coverage ratio goal of less than 35% is it's going to take 35% to cover the monthly mortgage. Less than 35% of the funds that come in is used to cover the monthly mortgage. Okay. So if it's greater than that, now it's like, oh my gosh, do I even have enough money to cover my mortgage? Right. That's a problem if it's too tight. Okay. All right. So again, hover to discover. I have a few examples in here for you. I would love, again, for those of you who are listening, I would love for you to hop onto YouTube to take a look and to see this powerful, powerful, powerful spreadsheet that my community and I have been using for the past 5 years or so. And so it has taken us out of a number of situations. So, in this particular scenario, this is a no go. This is a no go for a number of reasons. I don't have my $1,500 cash flow per month. Okay. Number two, the amount of income that's coming in, quite a bit of it is being used to cover the debt. More than 35% of it, 40% of it, 41% of it is used to cover the monthly mortgage. So nearly half, right? So that's not a good place to be. So no go. However, do not despair. I actually have some scenarios that I want to chat with you about that our members in our community have been able to leverage. Okay. Yes, we see that interest rates are going to start creeping up according to what the folks are telling us, the nonpartisan folks. I think it was Market Watch shared that information. Okay. So, with that being said, that we're anticipating the mortgage rates to go up with that, the thought is okay, can we create a scenario where this is a win win situation? So, one way that our members just this week, have been able to create such a scenario is by offering less than the listed price for the property. Okay, so we have one under contract right now. It's on sale for $740,000, and we offered $680,000, and the offer's in, it got accepted. We shall see, right? We shall see. So, what if we were able to offer 280,000, and what if that was accepted, right? What if that was accepted? So what would that mean? Oh, did our numbers not? Let's move it and let's see. So 280. Okay, so take a look. This leverage net cash flow came from $1,000 to $1,300. So we are getting close. We're getting really, really close. What are some other levers that we can pull? Well, what if we did a deep dive analysis and we found that we can achieve an occupancy rate of, let's say, 62%. 62%. Let's see what that looks like. Oh, did you see that? So next thing you know, we've got a leverage net cash flow of 2,400. Now we are cooking. Now we're cooking. Now we're cooking. Now we're cooking. So with that being said, absolutely love the ability to go back and forth and to see what kind of levers we can pull. Other levers that we can pull is taking a look at our um, funding, right? So what if one lender, and I'm taking a look at our funding, what if one lender is quoting us one particular interest rate, and then we have another credible lender that's quoting us an improved interest rate? You want to take that into consideration. Or it may be the same lender that has a few different products that you can take advantage of. Okay. I'm not saying to go out here on the streets and find rando lenders who just will not close, who do not understand the strategy and who do not understand what it is that you're trying to accomplish. Beware, beware. Those folks are out there as well. So avoid those folks like the plague. However, let's say we got a 6%. Let's see what that would do to our numbers. So it continues to improve our numbers as well. And of course, we want to allocate and account for our expense ratio. I would say 42% is the goal. We would update that by actually updating our monthly expenses. So if property taxes were $450 a month, okay, so we're getting closer. We're at the 30% mark. And that gives us the reality check of what our expenses would look like. Okay. All right. So I do not want to spreadsheet you to death. I feel like I've already spent way too much time on the spreadsheet. So let me go back to my main camera. There we go. Okay, so I'm back to my main camera. Again, just wanted to give you a step-by-step insight on the final step. So we've gone through zooming into a particular market based on the zip code. We have gone through using filters inside of AirDNA. Oh, I think I'm freezing. Am I freezing? Some lag on the camera. Darn it. Okay, whenever I switch gears, there is some lag on the camera. Okay, so we've gone through looking at our filters. I truly believe that filters are your friends. We have evaluated just removing data that just does not make sense. So that's essentially removing bad data. From there, we have exported spreadsheets where you have seen me walk through what we call the PACU methodology, where we're looking at proximity, amenities, competitive edge, and quality. And lastly, we just went through underwriting, guys. We just went through underwriting. Okay, so I am frozen on camera. I'm being told I am frozen on camera. However, the audio is still good. So maybe we can add a little B-roll in the edits while I am frozen. So again, guys, just wanted to come in here and shed some light on our current situation and let you know and empower you to know that in fact you still hold the power. You have an opportunity to make an impact on your life, on your children's life, on your children's life. Okay, I truly believe that doing all of this work up front has made a massive difference for my success and has helped me build a system that keeps on working for me. It keeps working for me. Okay. And I believe that it can work for you as well. So, my friends, if you're ready to take action and to see where I am putting this framework, putting this cash on cash calculator to work, check out our free resource. We have 75gems.com and 75gems.com. This is our top 75 cities with highest profitability for short-term rentals. I would love for you to check that out. And remember this, the only way to build momentum is to take that first step. It's time to build, my beautiful friends, my gems. So let's make it happen. Bye-bye for now, and I love you all to the moon and back. Bye-bye.